Welcome to the Power Market Report. I'm Albert Liu. I'm happy to be joined once again by James Rickards. He is the best-selling author of Currency Wars, The Death of Money, The New Case for Gold, and The Road to Ruin. He's also the co-founder of Meraglim Holdings, which is a pioneer in predictive data analytics. James, thanks for joining me back on the Power Market Report. How are you?
I'm fine, Albert. Thank you. And it's great to be with you again.
The last time I saw you, James, was back in July at our conference in Vancouver. You made some bold predictions in an interview with me regarding China, regarding North Korea, geopolitics in general, how the markets had not priced a lot of that risk in. And, a lot's happened since then. So can you talk about, first revisit the topics we discussed back in July and then bring us up to date on where that stands today?
Sure. We had two big topics then, Albert. You're right. It was at the end of July. We were both in Vancouver for a very large natural resource conference. And what I said at the time, I basically gave a warning, a forecast of a war with North Korea, a preventive war started by the United States against North Korea to dismantle their nuclear weapons and intercontinental ballistic missile programs, and also to decapitate the regime and precipitate regime change in North Korea. Since then, everything I've done, everything I've learned has confirmed that forecast. I would say that we can box it fairly narrowly. These are things that will happen before the end of March. I based that on some meetings I had in Washington. I'm on the board of a foundation that hosted a small private meeting with Mike Pompeo, the director of Central Intelligence Agency, and General H.R. McMaster, the National Security Advisor to President Trump. And interestingly, Albert, after I left you in July, I kept working on this problem. It's one of the most challenging problems I've ever worked on. And throughout the month of August and September, everything I was seeing confirmed my thesis, in particular a series of missile launches over Japan. I mean, I don't know if you know, but school children in Japan, they have, and adults for that matter, they all have cell phones just like everyone else. And I'm sure on your own cell phone, I know on mine, you get these push alerts, sometimes a tornado warning or a brush fire warning or whatever. Well, people in Hokkaido, in the northern island of Japan, got a warning, a duck and cover. There's a North Korean missile coming. And there was. It flew right over Japanese territory. Now it went out into the Pacific Ocean, but there's no assurance that it wasn't heading for Hokkaido when it first launched. There's no assurance that it doesn't break up and fall in parts. So, you got to put yourself in the shoes of these people where they're getting duck and cover warnings about North Korean missiles. Then on September 3rd, North Korea detonated an H-bomb, a hydrogen bomb, which of course is a different, far more powerful technology than an atomic bomb. Atomic bomb is a fission weapon. An H-bomb is a fusion weapon. We don't have to get into all the physics of that, but suffice to say it's exponentially more powerful than anything North Korea had. So they were moving very quickly down this path of ICBMs, H-bombs, marrying the two technologies, building, say, an arsenal of let's say 10 to 15 of these H-bomb tipped ICBMs, which could basically destroy American civilization in a matter of hours. People talk about our anti-missile technology. It's pretty good. It's the best in the world, but it's not better than a 50% kill ratio, meaning if North Korea launched 10 missiles, at best we could shoot down 5, probably 3, which means we would lose, let's say, Los Angeles, Seattle, San Diego, Denver, Chicago. This would obviously cause a significant societal, social breakdown in the U.S. and probably lead to martial law just as a way of dealing with the damage. So that's what we're facing. And but then I went around to a lot of experts, particularly in early October. I reached out to CIA assets, other people with other connections to the intelligence community, people who were looking at satellite imagery, et cetera. And what I heard from them was, it's too bad, but they got us, in the words of Steve Bannon, that the costs of launching a preventive attack on North Korea were simply too high, that this could involve a nuclear weapon in Seoul, Korea, nuclear weapons at Japan, and it was too bad we didn't do something 5 years ago or 10 years ago, but we were just going to have to contain North Korea, use deterrence to bottle them up, use sanctions, diplomacy to try to get them to stand down. But the bottom line was that it was too late to do anything about it militarily. So I walked into my meeting with Pompeo and McMaster prepared to say, yeah, the war's not coming because the costs are too high, based on what I was hearing from these other experts. I heard the exact opposite from the two people closest to the president. I mean, Pompeo's in the Oval Office every morning. President Trump takes his what's called the PDF, PDB, rather, President's Daily Brief, from Pompeo personally. In the past, the CIA has sent what they call a briefer over to the White House, but President was hearing from Pompeo directly, so he's in the Oval Office every day. McMaster, is 2 doors down the hall in the West Wing. That's who I was hearing from. Pompeo said it would be imprudent to assume that it will take North Korea more than 5 months to get this capability to pose an existential threat to the United States. So this was on October 20th. So that's when I pegged the outside date for the war on March 20th. And then McMaster said, and these were the key words, he said acceptance is unacceptable, meaning acceptance of North Korea as a nuclear armed power is an unacceptable posture for the United States. So here are the two people closest to the president telling me we got a few months to get this to solve this problem, and we are not going to allow North Korea to have these weapons. So that means we're on the path to war, unless one of two other things happens. One is that Kim Jong-un stands down. He just says, okay, you got me. I'm willing to disarm and just continue my programs, do that verifiably, and let inspectors in. There is zero evidence that he's doing that, by the way. It's a possibility. I give it a 10% probability, but there's zero evidence that that's actually happening. The other path is assassination and regime change. And that's what President Trump was talking to President Xi Jinping in Beijing a few weeks ago during his visit to China. And there, it was interesting in the meeting I attended with Mike Pompeo. Someone asked him, why don't we just assassinate Kim Jong-un and get this over with? And of course, we all know assassination is illegal, particularly by the CIA. They used to do things like that, and that's made illegal. And Pompeo knows that. And his exact answer to the question was, I'm not going to answer that. And then he paused, and then he said, because if an unfortunate accident should befall the man, I would not want my words to be misconstrued. I mean, it was like talking to John Gotti, or the Godfather. So the point is, yeah, we are working on that. And I heard that from other CIA sources as well. So putting all that together, I would give a 10% probability to Kim Jong-un standing down, a 20% probability to a successful assassination and regime change effort, a 70% probability to war, and a 0% probability that the U.S. is going to accept a nuclear armed North Korea. So putting all that together, looks like we're heading for war, and it's not priced into markets. I'm not saying that people should run out and take all their money out of the bank and sell all their stocks. I'm just saying that that's a pretty big geopolitical risk that is not priced in the markets.
James, a couple questions in response. How much attention should we be placing on the language that's coming out of the White House? I'm thinking in particular of the fire and fury comment, and also the return of a load of nonsense from North Korea. Should we be paying attention to that, or should we be looking at other things to inform us that this situation is actually escalating? And then what will be the first casualty in the financial markets if we get that sign?
Well, yes, we should be paying attention. Well, we should be doing both is the answer. Your question, there's a lot of name calling going back and forth between, Trump calls Kim Jong-un Little Rocket Man, and Kim Jong-un has some, pretty derogatory things to say about President Trump. And should we look at that, or should we look at, intelligence and more substantive things? The answer is we should look at both. One of the problems, and I met with with the director of strategic studies program at Tsinghua University in Beijing. So really, they're leading think tank on national security issues. Someone who does brief senior Chinese leadership. I met with her in Washington a few weeks ago, about a month and a half ago, and she said to me that Beijing believes the United States is bluffing, and it was the whole scenario I outlined for you, Albert, at the beginning of this interview, that China believes this is just posturing by the United States and that we're bluffing. I said, well, we're not bluffing, and you go back to Beijing and tell them that, because this is on a path to war. By the way, there has been a slowdown since September in the operational tempo of the North Korean weapons testing. It's not clear exactly why, but they did have that implosion and tunnel collapse, several hundred workers killed at their nuclear testing site. Some experts believe this is what's called mountain fatigue. They've used the same underground bunkers in the same mountain for a number of nuclear tests. So if you do that enough, you're going to implode the mountain as a whole. By the way, that's a threat to China, because even if it were just a man-made natural disaster, if you want to put it that way, that mountain collapses, that's going to release a huge amount of radiation from all the prior tests. Right now it's bottled up inside the mountain, but that could release a radioactive cloud, which based on prevailing winds would mostly fall on China. But at a minimum, several hundred workers were buried under these collapsing tunnels. That may have slowed down their nuclear testing, the detonations. It shouldn't, in theory, slow down the missile testing, unless they're trying to develop a warhead to put on the missile. And there's pretty good intelligence coming out of Japan, signals intelligence that North Korea is getting ready for another missile launch literally in the next couple of days. As we speak, we might expect this missile launch as early as December 1st. So North Korea is still going down the path. So I would say don't discard the rhetoric, but pay attention to the intelligence also. We're still on this path I described. China is tightening the sanctions on North Korea. They're to kind of appease the United States, to fend off a trade war and a currency war with the U.S., which is another whole issue. I mean, if it becomes clear that we have to go to war with North Korea and China hasn't helped us prevent it, why should Trump refrain from launching a trade war with China, which is what Robert Lighthizer, the U.S. Trade Representative, and Wilbur Ross, Secretary of Commerce, Peter Navarro, White House Counsel on Trade, all three of them are super trade hawks. They've been kept on a short leash because we're hoping China helps us with North Korea. But if they don't, or if their help is of no use because we have the war anyway, there's no reason not to go into the trade war with China, which I also expect. So, all these factors are relevant.
Okay, and that was actually the other half of the discussion back in Vancouver, was the trade war. James, I want to shift gears a little bit. It's November 28th. Jerome Powell's confirmation hearing started just an hour or so ago, so I want to shift to the Federal Reserve. We did talk about that before, earlier in the year. At the time, this is, I think, back in perhaps March or April, you were thinking that Kevin Warsh was the lead horse there, and he certainly made it to the final round, as did John Taylor and some others. They went with Jerome Powell, or he went with Jerome Powell. How surprising was that to you, and why do you think he made that choice?
It was a little surprising. These things are, I like going to horse races. I like betting on horses, and sometimes you make a bet and the horse breaks its leg and out of the gate. I was expecting Warsh. It turned out to be Powell. The good news, it's good news, but it's just the case that Powell actually makes it easier to analyze Federal Reserve policy, because Powell will do exactly what Yellen was doing. So, Albert, I've had a Fed model all along. It's worked extremely well. When we met in July, I said the Fed was done for the year, and indeed they did not raise interest rates in September, which is what I told viewers at the end of July. But it's also my view that they're not going to raise rates in December. There's an FOMC meeting, Federal Open Market Committee meeting, part of the Federal Reserve function, the rate policy setting committee that meets on December 13th. My forecast as of now is that they're not going to raise rates. Now, that's way, way out of consensus. The market consensus is close to 100% that they will raise rates. But I based my July forecast of no hike in September or December on disinflation. That disinflation has not gone away. In fact, it's actually gotten worse since we spoke in July. The most recent data for September and October is at 1.3%. That the 1.3% inflation using the Fed's preferred metric, which is PCE deflator, core year over year. A little bit geeky, but that's, of all the measures of inflation, CPI, PPI, trim mean, core, non-core, PC, et cetera, PCE core year over year is the one that the Fed uses. They tell us that their target is 2%. Last January, it was 1.9%. Actually, December 2016, it was 1.9%. It has been down or flat 9 months in a row. When we spoke, it was at 1.4%. Today, it's at 1.3%, still moving in the wrong direction. Now, there's another release coming out, 8:30 a.m., Thursday, November 30th. So literally a day or so away from when we're doing this interview. Let's see what it is. My expectation is that it will be weak. But regardless, it's certainly the case that if that comes in 1.3% or lower, it's hard to imagine the Fed raising rates on December 13th. They're just failing to meet part of the dual mandate. Now, if it's 1.6% or higher, that's hot. That would tend to validate Yellen's thesis that the disinflation is transitory, and that would green light a rate hike on December 13th. So if I see 1.6, I'll throw in the towel. I'll join the consensus, maybe. But for now, I'm standing by my model, and I do expect a weak number, and I do not expect a rate hike in December. But having said that, there are two other huge hurdles that Janet Yellen has to clear before she can raise rates in December. The second one is this tax cut. The Senate's voting Friday, December 1st on this tax cut. Let's see what happens. Right now, the market's expecting that that's going to pass. It's already passed the House. By the way, I'm using the word tax cut. It's really not a tax cut. It's a tax cut for corporations and some rich people. It's not a tax cut for me, by the way. I live in Connecticut, so I'm getting hammered with this taking away the state and local tax deduction. I'm not whining about it, but I'm just making the point that for a lot of people, this is not a tax cut. But be that as it may, whatever you call a tax reform, this is a really lousy bill. And I don't say that because of my personal situation. I say it because it doesn't provide incentives for consumption and investment and the kinds of things that the Trump people are talking about. But be that as it may, the market expects it will be stimulative, and the market has priced it in. But they need 50 votes. Right now, they don't have 50 votes. There are 53 Republican senators. Of course, there'll be no Democrats voting for it. There are 53 Republican senators. They can lose three. There are 52 Republican senators. They can lose two and still win with a 50-50 tie and a tiebreaker by Mike Pence. But if they lose three, this bill fails. Well, two senators have already come out against it, Ron Johnson, and there was another senator last night, and there were at least three other senators who could oppose it who have not spoken up yet, John McCain, Jeff Flake, and Susan Collins. So let's see how it all plays out. But this thing could crash and burn on Friday, and that would immediately, because it might be around midnight, but watch what happens to stocks on Monday at the open. They could collapse because they priced in a tax cut. If the tax cut fails, look out below for the stock market. And then that's another reason Yellen can't raise rates, because a disorderly decline in the stock market is one of the reasons why they won't. Third hurdle, December 8th, don't forget we have a government shutdown. Now, I'm not saying the government will shut down. I'm saying right now it is scheduled to shut down. The government spending authority expires on Friday, December 8th. Will the Congress patch it together and come up with another continuing resolution? They might, but think of the issues that are on the table. Financial bailout for Obamacare, funding for Trump's wall, DACA, the so-called Dreamer immigration fix. There are many, many other things, funding for Planned Parenthood, et cetera. It's hard to see how all this gets compromised, and Trump has punted on the wall twice in March and September. Pardon me, the only reason he went along with the delay in September was because they needed the disaster relief for Hurricane Harvey, Irma, and Maria. So Trump said no member of Congress, nor the White House, wanted to shut down the government at a time when we were in the middle of disaster recovery in several major cities. But that's behind us. I mean, they're still cleaning up in Houston, but the disaster phase is over. But so now you don't have that incentive for Trump to play along with the Congress. And also the budget, the Treasury's borrowing authority expires on December 8th. Now, they can use what they call extraordinary measures, shuck and jive a little bit and, dip into some funds and, in extremis, they can reprice gold. There are a lot of things they can do to keep paying the bills. But technically it expires. All this uncertainty, can you imagine the Fed raising rates when the government shut down? I can. I mean, that's really pouring salt on the wound. So Yellen's got to clear three hurdles. She needs a hot inflation number on Thursday. She needs a Senate passing the tax bill on Friday, and she needs no government shutdown a week from Friday. If you gave each one of those a 33% probability of failing, so say 2/3 chance they work out, 1/3 chance they don't, a 33% chance of failure on three discrete events is a 99% chance of failure. So this is why I don't think she's going to raise rates. But let's maybe she'll pull a trifecta. Let's see how it plays out.
James, I didn't really know much about Jay Powell going into this race. The more I learn about him, he seems to be the perfect pick for this president. He's running the Janet Yellen playbook. Donald Trump is a low interest rate person. He's kind of, he's not an academic, so he's sort of the working man's Janet Yellen. Kevin Warsh seems like a great choice as well, but he's been a little bit too honest since he left the Fed last time, and that's going to be baggage. And then with John Taylor, if inflation picks up, it's going to be hard for a guy named John Taylor to ignore the Taylor rule. So I think Trump threaded that needle quite perfectly, actually. What I want to ask you is, Bernanke was very outspoken and academic before he became Fed chair. Yellen was also outspoken and had a reputation as being very dovish. Jerome Powell doesn't strike me as someone who's going to be very innovative when it comes to Fed policy. What do you think? Do you think if things go south again, is he going to be really innovative in the way he approaches? And then, as an example, just QE, the taper, all of that stuff was sort of unprecedented. Does he have it in him to do stuff like that, or is he just going to come with something very simple?
I worked with, when Jay Powell was at the Treasury, and I was general counsel, one of the primary dealers who were the underwriters of the U.S. government securities market. We interacted a number of times. And my impression of Jay is the same as everybody's impression. Everybody likes Jay Powell, and that's rare in Washington to have someone who's well-liked by Republicans and Democrats. So I think that's a plus. He's a smart guy. He's a good guy. But as you correctly point out, he's a lawyer, and I actually consider being a lawyer rather than a PhD economist to be a plus, because lawyers tend to be very pragmatic. PhD economists tend to be more ideological, and they're wedded to obsolete models, and they get a lot of things wrong. So I like all those things about Jay Powell. Having said that, I think he's just going to follow the Yellen and Bernanke playbook. The case for Warsh, and I agree that he was probably a little too outspoken. See, Warsh is very independent. So if you pick Warsh, you're going to get an independent chairman of the Fed. That's not what the White House wanted. They wanted somebody, what the elites call a safe pair of hands, somebody who would come in and do exactly what they want, exactly what they expect. So Warsh and Powell are both lawyers, but Warsh is sort of an independent thinker, and Powell is going to, I think, go along with the Yellen playbook. So in a new financial crisis, I would expect him to do exactly what Janet Yellen would have done, which is first you don't raise rates. Then you cut rates back to zero. They could cut rates 4 times or at 25 basis points each and get back to zero. And then you go to QE4. Stop the right now they're not just tapering new asset purchases. That was over in 2014. What they're doing now is reducing the balance sheet. They are tightening the money supply. They are reducing base money. My view, the economy is very weak. Do you really raise rates and reduce base money when the economy is weak? Well, no, except that they have to get ready for the next recession. They're playing catch up. Like, why on earth are they reducing the balance sheet, which is a form of tightening, and raising interest rates, which is a form of tightening, putting a double whammy on the economy when the economy is struggling and has not regained trend growth? Well, the answer is that they should have done all this in 2010, 2011, not expanded the balance sheet as much, raised rates, normalized things back then when the economy could bear it. Bernanke missed an entire cycle, and now the Fed's playing catch up. They're desperate to normalize rates, normalize the balance sheet before the next recession. But the problem, of course, is, how can you normalize rates and balance sheet before the next recession without causing the recession you're preparing to cure? The answer is you can't. They're gonna mess this up, in which case it's back to, at best, a recession, at worst, a financial crisis. And Powell, I don't look for him to be that innovative. I would look for him to just basically run the Bernanke-Yellen playbook, which is cut rates and go to QE4.
How should we be looking at interest rates now? Let's say the Fed does hike, or even if they don't, like you said, they're desperately trying to raise interest rates on the short end. Meanwhile, you have the long end sort of being held by the Bank of Japan and the ECB. And so this thing's flattening. Some people think it's going to invert, which in the past has signaled a recession. But in this case, when you actually have, let's call central bank intervention flattening it and not the market because of the involvement of the ECB and the Bank of Japan, how should we be looking at this yield curve?
Well, this is a result of 9 years of central bank manipulation. I mean, the central bank, the Federal Reserve in particular, uh, gave up its customary role. I mean, the Federal Reserve should only do two things: price stability, and they should be a lender of last resort in a crisis. That's all they should do. The idea that the Federal Reserve can stimulate the economy or create jobs, that's all nonsense. I mean, that's not what central banks do. They pretend that they do. They talk about it. Wall Street talks about it ad nauseum. But we have not had a return to trend growth in 8 years, despite $4 trillion of money printing by the Fed. We have not had the inflation that a lot of people expected because of the absence of velocity, which is a psychological phenomenon. It has nothing to do with money supply. Moreover, the weakness in the economy is a structural problem. You cannot solve a structural problem with a monetary solution. You need a structural solution. So for all these reasons, the Fed is essentially impotent, but everyone wants to pretend they're omnipotent. But the point is, going forward, there's no question that the base case for the Fed is 4 interest rate hikes a year, 25 basis points at a time, every March, June, September, December, like clockwork, until they get up to around 3.25%, sometimes in late, say 2019. That's the base case. That's what they're trying to do. So why do I say that they're not going to raise rates in December when I just said that their base case is to raise rates 4 times a year, including December? The answer is there are 3 pause factors. There are 3 reasons why the Fed would not raise rates, despite the base case of trying to raise them 4 times a year. The 3 pause factors are disorderly stock market decline, job creation, below 75,000 a month. Ignore September because that was hurricane related, but below 75,000 a month. And the third one is disinflation, moving away from their inflation target. Well, that's the one that's operative right now. By the way, 2 of them might be operative. If the Senate doesn't pass the tax bill on Friday, you might see a disorderly decline in the stock market. So 2 of them would be operative, which is disorderly markets and disinflation. But one's enough. And again, if you get a weak PC number on Thursday, 1.2, 1.1, or even lower, I mean, that's going to put a nail in the coffin of the rate hike. So you have the base case, you have the 3 pause factors, and then as an analyst, you say, well, are any of the pause factors operative? If not, then they're going to raise rates as I described. If yes, then they won't raise rates. And so that's, but what's interesting, Albert, is that you have some very, very interesting, what I call asymmetric trades. An asymmetric trade is heads I win, tails I don't lose, meaning if you put the trade on, for example, there are many of them, the euro, gold, yen, treasury notes, all of them are priced for a rate hike. Right now, gold's been kind of weak, the euro's been going nowhere, yen's been weak, dollar's been strong, yields are up, bond prices are down. All those things are based on an expectation that the Fed will hike rates in December. If the Fed hikes rates in December, nothing happens because the market's already priced for all those things. You're going to need some other events, some other news to get the market moving one way or the other. But if the Fed doesn't hike rates, which is what I expect, the market's going to have to reprice violently. All of a sudden, gold's going to soar, yields are going to crash, notes are going to soar, euro's going to go back to over 120, gold's going to be way over 1,300, the yen's going to be under 110, yield to maturity and 10-year treasury notes going to be 2.1. All those things are going to violently reprice. So you have a nice set of trades where if you put them on, and if I'm wrong and the Fed hikes, you don't lose much because they're already priced. But if I'm right and the Fed doesn't hike, you could have some huge gains.
Very interesting, James. I have lots of questions, but unfortunately we're out of time. So I'll let the viewers know they can follow James on Twitter at jamesgrickards.com. Meraglim.com is the website. You can check me out at Albert K. Liu. James, thanks for joining me on the Power and Market Report, and I look forward to doing it next time.
Thanks, Albert.